Alright, what is up everyone, what is up? I think people should be getting the notifications here. Oh, hello guys, hello. Alright, I think I'll just begin. So, let's go right into the topic for tonight, and that is bonds. Okay, bonds. It's all about bonds. This might be a boring topic, but it's a very essential topic that you guys should know about, especially since I've titled the stream. Alright, what does it say, guys, in the title? What does it say? The year is 2027. Right? So the reason why I say this is that, first of all, we have to look at bond yields. All right, bond yields have been moving in a very interesting way. All right, we obviously had that yield curve fears back in, I believe, what was it, 2024? Was it 2024? I think. Let me make sure I get the year right. I don't know. So the yield curve inversion began in 2022. That's right. So it lasted for 2 years, not 2 years ago. I was remembering that wrong. But the yield curve inversion began in 2022, and that kind of essentially, basically, guys. By the way, yield curve inverted yields essentially tells you that for sure an economic recession is on the way. But interestingly enough, the authorities back then in 2022 were saying that, you know, it's not really a recession that we'll be seeing, and they kind of changed the definition of what a recession is, even if we basically had the textbook definition of a recession by seeing 2 negative quarters of GDP right back to back. And we essentially saw economists and federal authorities is telling us that, hey, we're really not in a recession. This is just a cool down period after the entire injection of money that went into the economy and the markets and etc. Right, during 2020 and 2021. But what's interesting is that with this complete change in the definition of what a recession is, it kind of shook up the Federal Reserve. It essentially allowed the Federal Reserve to hike interest rates in the entirety of 2022. Right, that's kind of the reasons why, or that's a major reason why we saw the bear market of 2022. But it allowed the Federal Reserve to basically hike rates without causing a Fed-induced recession. Right, so that's kind of the entire purpose of what I believe was the unofficial, I would say, unofficial change of the definition of what a recession is. I don't agree with it. I really don't think they should have said that. They should have done that either as well. I criticized that. I even criticized during that time the Biden administration for allowing that. Right, but. Either way, from a longer term perspective though, I can see why they changed that definition, and why it essentially was a cool off period, right, from a lot of inflated areas of the economy due to the pouring of money and that we saw in the pouring of demand from consumers right after the basically the global economic closures began. So this inverted yield curve, right? The inverted yield curve here, or yield curve inversion, I believe was the longest inversion in history, in modern history, I think, right? I'm pretty sure. It lasted for 2 years, right? And it didn't resolve into anything. Again, they would usually signal, right, that an economic recession is on the way, but that's not what happened, right? The 2-year yield was showing higher yield percentage compared to the 10-year yield, right? So, essentially, I think in 2024, or I think late 2023, there are signs of the quote-unquote normalization of the yield curve, right? As the 2-year yield began to finally drop, and 10-year yield began to yield quote-unquote more, right? That's essentially how you use these terms, right? So, I think the consequences of that now is something that we need to be watching out for, especially as if you take a look at the 10-year itself here. All right, now let's take a look at the screen, the TNX, or the 10-year Treasury note yield. Essentially, what we're seeing here, I would say, as I told my readers last night in the report, right? You can't really do technical. Hey, what's up, guys? Hello. Right, you can't really do technical analysis on on yields like this, but you can't deny the fact that yields have been making a very massive bull flag here, right? There's a nice big bull flag or even a wedge, and based on the left-hand side here of this overall bull flag, it seems like we've been consolidating for the last three and a half years to eventually give us a nice bigger breakout to the upside. And that's not good, right? So if yields are going to go higher, right, bond prices can go down, okay? Now here's the thing, guys. What's happening right now though, right? So if you were to want to avoid this quote-unquote second leg up higher in yields, if you were to throw out any technical analysis, because again, many can argue that doing technical analysis on yields, they don't make sense, just like how with the crowd with that you can't the crowd that says you can't do technical analysis on the VIX, right? Which, okay, I understand that too, but anyways, if you were to throw out technical analysis, right, and we just want to see yields just going down, okay, that's not good either. Right? Because what does that essentially mean, right? Because yields, bond yields specifically, are inversely correlated and related to bond prices. So if yields are going down, right, what does that mean for bond prices, guys? Right? Do the little hand motions with me, right? On the left hand, if bond yields are going down, right, bond prices will be going up on your right hand, and then vice versa. So if bond prices are going up, something is wrong in the underlying economy, because investors are piling into bonds. And what does that usually mean historically? They want protection, right? They want long-term protection. And there is a chance that we could be seeing, again, this yield curve inversion again, where we start to see investors panicking and we start to see them piling into shorter maturity, into these long-term maturity bonds, right? And this yield curve inversion can occur again as the 2-year yield bumps higher, right? It starts to rocket higher, and the 10-year begins to drop, right? So again, it's going to be interesting as how we end this year with the bond markets, because it's going to really play out into 2027, in my opinion. as this entire AI infrastructure build out continues, and how the overall economy continues to fare with high inflation, with now flatlining wage growth, the labor market, right? So, and obviously the potential for the Federal Reserve to potentially hike rates, right? Now, here's the thing. In my previous live streams, I think about 2 live streams ago, I gave my prospectus about, or my prospect, excuse me, about still having 1 rate cut at the end of this year. And I find that argument that I've made to still be very relevant, because right now bonds have been moving higher, right? And again, I gave you guys a reason why maybe if we were to get that rate cut, that 1 rate cut by the end of this year, even if markets aren't pricing that in yet, or not anymore actually, if a rate cut is supposed to come right by the end of this year, right, if the markets aren't seeing it, we can see the negative repercussions from that rate cut, as I've explained in that previous stream, because it will be premature, obviously premature first of all, and number 2, the economy is hot, right? As gas prices are going down, that can actually put in a new factor for inflation, which is going to be energy-driven inflation, as people are able to spend more with their discretionary income, right? They're spending less on their basic needs like energy, because gas prices are going down, natural gas and crude oil prices are going down and have come down, and that can further inflate prices as consumer demand picks back up, which ultimately results in an even hotter economy, right? And the economy is already hot. We've already seen that. The labor market is relatively stable now, even if unemployment's still at relative highs, but that's where we're at, right? We're kind of in this stagnancy. Again, we've talked about stagflation before as well, where things aren't really going anywhere, essentially, right? The economy is stagnant. And that's a problem, right? That's a problem that the Federal Reserve has to deal with. It has to get us out of, right? Without, again, crashing the economy, which is essentially what they were able to do in 2022 just by tweaking the definition of what a recession is, an economic recession. And they were able to hike and hike and hike rates without, again, formally introducing a Fed-induced recession. So how does this all tie in with the bond markets? Well, the longer dated maturity bonds and the short dated maturity bonds for the last couple of weeks have been suspiciously moving up in tandem. We've seen the ticker symbol IEF, this is 7 to 10 year Treasury bond ETF, IEI, the 3 to 7 year Treasury bond ETF. So first of all, before I delve further, the shorter dated maturity bonds are less sensitive to the overall interest rates and yields. And actually, let me show you guys something here. So again, hold that information in your head, right? Always remember that. They're less sensitive to the overall federal funds rate compared to the longer term and longer dated maturity bonds like TLT here, which is the 20+ year Treasury bond ETF. So let me show you guys this. Let me see if I can find it here. Okay, so I want to. I don't think I can find this here. I don't see it in my history. I don't know where I put it. I thought it was in this tab or. It doesn't really matter. Anyways, I have my information in the head, but I just wanted to show you guys an article. But anyways, to further elaborate on my quote-unquote thesis that I've had about why rate cuts can still occur this year, at least one, is that, well, the bonds suspiciously have been rising, bond prices specifically, and yields have been falling for the past couple of weeks, especially this long-term maturity bond, which is again sensitive to interest rates. So if the markets are pricing in a potential rate hike, right? As the dot plot has been completely revised in the last FOMC meeting, where there's been a huge turnover of the FOMC committee members or governors starting to expect rate hikes to be back on the table, right? Back into the decision-making table. And so the markets have basically said, oh, okay, well, but then we should expect to see rate hikes either by the end of this year or even by early next year. But what's happening to the bond markets, right? They have reacted very positively to that news, which is not what you should be expecting, right? And so when interest rates fall, okay, bond prices tend to rise, especially the ones that are sensitive to interest rates, like TLT here. And that's not what happened, right? Because the markets have been pricing in now a new pivotal shift towards expecting a rate hike. So if they're expecting that, then bond prices should be falling, right? And yields should be moving higher. Except that's not what happened for the 10-year or even the 30-year, right? So the 30-year has also fallen since the FOMC meeting of this month. So someone is lying, right? And I would expect to see the bond markets to not be the liars, because they tend to be kind of the leading indicator here of what the markets are seeing and what the markets are expecting actually in the future, right? So this is the reason why I'm saying this is very important to look at bonds for the rest of this year, and it will very much correlate to the equity markets and how it performs, and also how we will be seeing the Federal Reserve move in the year 2027. So again, I am still going to hold onto the thesis that the Federal Reserve will still try to cut rates under the helm of the new chairman, Kevin Warsh. Obviously, he has his own personal financial conflicts, but again, if you guys are readers of the CFO Report, and if you guys read the past two reports, including the past three reports, including last night's report, just read it all together, and you guys will get a coherent thesis of what I've been expecting and what I will be expecting by the end of this year and into 2027. All right. So please read it again. Just go back 3 weeks, okay, and read that report first, and then continue from that point forward. So, when it comes to the TLT here, the 20+ year Treasury bond, I really find it particularly interesting that, hey, what's up, man, Bueller? What is up? That, we basically have to at least choose a side here at this point, right? Obviously, we still have into the end of this year. We still have 4 more FOMC meetings, okay? And currently, let me even just show you guys here. Just look at the Fed Watch tool that we use here. All right, Trust Focus 1. So we have 4 more FOMC meetings left, right? One in July and one in September, October, and December. We went over this already. But what we're expecting now is actually in, I think, what was it? December, yeah, December here, right? So we are seeing the odds of one single 25 basis point hike to come, right? As the probability of seeing a rate hike of 25 basis points has gone up, okay, across every single last FOMC meeting left for this year. Okay, do you guys see here? Okay. Right now we're at 3.50% and 3.75%. That is the current federal funds rate. And the probabilities of one rate hike has gone up a lot, right, since the last time. I mean, just a month ago. Look at this, guys. Look at right here. Right, so 125 BP hike will give us 3.75% to 4.0%. And in May, right, just again last year, that probability was at 24.8%, but now we're sitting at 46.2%. So again, do we trust what the markets are saying, or do we trust exactly what the bond markets are saying, right? Because someone is lying here, right? So something is not right. So I'm going to continue to trust what the bond markets are saying here, especially the yields and bond prices themselves, and continue to hold my thesis that I told you guys about a couple of streams ago about why I think we will still get one interest rate cut by the end of this year. Okay, and again, there's a lot of different factors at play. Obviously, there's a lot of different nuances, just like anything in this world. Nothing is black and white. It never is, right? Especially when it comes with the markets and even socioeconomic factors, political everything is nuanced. Okay, nothing is black and white. Okay, even if maybe politicians may try to make it sound like everything's black and white, like our current president, right? Trump, the complete failure of a president there. And so, we have to be, looking at multiple different data points, multiple different reports, and go off of that. You can't just, cut rates just because the president wants it, right? That's not how things work, okay? So, it's very, very interesting to see how the bond markets have been reacting to what we've been seeing so far post FOMC meeting, and I'm going to continue to look into this, especially as we would expect to see bond prices going down, right? But that's not what we're seeing here. So, I really want to make sure that in tonight's stream so far that you guys understand that the markets have been pricing in 125 BP cut, but depending on how the labor market and jobs data goes for the next couple of weeks, right? The next couple of months, and even just the weekly data point that we get about jobless claims, right? That's also very important too to consider. So again, very big objective needs to be handled here by the Federal Reserve because their dual mandate has been completely broken apart thanks to this current administration. So, and again, I warned everyone about this back in 2024, right? What this administration can do, what this one single party that has taken control of the entire 3 branches of the government can do, right? So here are the consequences so far, and I believe the bond markets can really truly tell us what could be happening here. And even if, guys, right, I know someone asked me, even if we don't get a single rate cut this year, even if I'm completely wrong, right, that's fine with me, right? Because the markets are nuanced, right? Nothing's black and white. It will truly make sense to me that bond prices will go up higher, especially the longer dated maturity bonds to go up higher, because they see more return. They're going to expect more returns out of these bonds, especially if risk on assets become a problem, right, in the year 2027 due to all the economic problems that we most likely will be seeing by next year. And I think right now, currently, we're seeing the early signs of that. And here's the thing, okay? Short to midterm perspective, short to midterm perspectives, I think bond prices can still come right back down too, and yields can actually go right back up as well too, as we head into the summer months. All right, I still think we still have a pretty good probability, I would say, starting from July for bond prices to come right back down and yields to go right back up because of, well, I've only specifically written about this for my readers, so make sure you guys become a reader of the CFO Swing Watch Report using the second link down below in the description box. But based on those specific factors, okay, the problems about the economy will come back to light, especially when it comes to the private credit markets. Little wink wink there to all my readers out there. I've talked about the private credit markets in February, and I told everyone back in February that I'm going to be touching on this subject again later this year, mid this year, right? And now we're in the second half of this year, and I touched base back onto that subject last Friday. And I know if any of my members here are watching, you guys know what I've said about that. It could actually be the another major reason why bond prices have started to go up, as people are starting to hedge against the potential problems that the private credit markets can experience. Okay, and I've given you guys evidence for that as well last Friday, so please look at that. So you know, this entire AI infrastructure build out, this current administration, it's just a complete mess. And I think this summer, these next couple of months are going to show, or at least re-show, right, the problems that we're going to be seeing or currently seeing in this economy. Does that make sense? And I think that's the reason why we're seeing both shorter dated maturity bonds and longer dated maturity bonds moving higher in tandem. Okay, because again, we truly don't see this much sensitivity post FOMC meeting compared to for the shorter dated maturity bonds compared to the longer dated maturity bonds. But here we are, right? We're seeing IEF and IEI and TLT all moving higher together, right? So it's truly fascinating, especially when we're actually, if we take a look at IEF or IEI, right, together, they've actually moved very quickly to the upside. So something's happening here, and it seems like investors are starting to really hone in on these specific macro issues that can fall onto equity markets either by later this year or into early next year. And again, maybe just maybe Kevin Warsh can announce a single rate cut for this year, at least hint at that, and the equity markets can absolutely tumble from that decision. Because again, a rate cut is not a good idea, has never been a good idea for the last year or so. Okay, so, and that's the reason why Jerome Powell has been leading with such good leadership skills, essentially, by correctly telling everyone, America, that they need to be doing this data by data. They can't just be politically pressured by one single man that doesn't know what he's doing. He has no idea what he's doing. Okay, and Jerome Powell essentially led the Federal Reserve into the end of his term here to focus on the data, right, and not be pressured to cut interest rates, because that will be a mistake. So now that there is a potential yes man in the Federal Reserve, as I've discussed, the reasons why he is a yes man, and he could be the yes man that Trump wants, if he indeed decides to cut rates by 125 basis point, right, later this year, just to see, right, just to test out the waters, let's say. Okay, maybe that could be the reasoning here. Or he simply just wants his own portfolio to do well in his first term here as Federal Reserve chairman. Either way, whatever it may be, it won't be good. And I think right now, both short-term and long-term maturity bonds are currently factoring that as well too, right? Because we have to look at the bigger picture. Okay, so if bond prices are rising, okay, maybe investors are starting to pile into, because of the fact that we're starting to see this negative consequence of this current AI build out, specifically regarding private credit markets, again, which I went over in depth back in February, before we saw all that that kind of craziness with redemption problems in the private credit markets and private credit funds in March. I talked about private credit markets in February, and then right after that, a month later, we got those wave of very negative news about the fact that private credit funds were starting to limit redemptions. So again, I'm not just saying this because I don't know what I'm talking about, right? I'm literally telling you guys that you have to look at this from multiple different angles, right? It's a nuanced subject. You can't look at this from a black and white perspective, like how the current stupid, president is doing, right? You can't just cut interest rates, all right? You can't just do that. So again, one interest rate cut, I think that's what the bond markets are currently pricing in. So I may be wrong. I could be completely wrong, right? The bond markets can be completely wrong too. And maybe what the overall markets are expecting is right. Maybe we're going to be seeing an interest rate hike, okay? But again, we need to look at either way, we need to be looking at bond prices into the end of this year and into next year. Does that make sense? Okay, so take a look at the 10-year here, TNX, very, very important. Yes. I know some of you guys will say you can't do technical analysis on yields, just like how you can't do technical analysis on the VIX. But I implore you guys, Truly, genuinely, just take a look at the 10-year. Always check on it every single month from this point forward, or every single week if you guys want to. But overall, we're building this big flag. And if this breaks out, yes, initially bond prices will fall because again, they're inversely correlated. But bond prices will actually climb right back up because the actual implications, right, of why yields are surging higher again and breaking out of this flag will be trouble, right? That means something is going on, right? And investors will start to pile massively into bonds into next year if yields break out at the end of this year, okay? So again, please watch the 10-year, look at the 30-year as well, look at the 2-year, compare the 2-year and the 10-year, right? That's a pair that everyone looks at because this is very important, right? It's something that a lot of economists use to determine liquidity as well for the overall markets. So again, I mean, if you guys remember in 2022, liquidity was a huge issue, and the markets essentially lost its liquidity to continue to trudge up higher, and eventually we saw that nice stair step down into a large market correction that led into a larger bear market. Okay, so again, the 2-year, 10-year, it can essentially give you an idea of where liquidity is for the overall markets, and also it can show you what investors are piling into when regarding what they want, right? If they want a higher yielding the asset, essentially, for the shorter term, they will try to go into the shorter term bonds like IEI, or if they want this short-term protection, right, from equity markets or just other risk-on assets. Okay, so yeah, this is a very complicated topic. I'm just giving you guys kind of the general idea of what you guys should be expecting into the end of this year. Into the end of this year and also into next year. So please take a look at this. But yeah, that's it for tonight, guys. I mean, I think again, I just want to kind of generally remind you guys of why bond markets are very intriguing right now, right? Very important and intriguing to be focused on, especially at the fact that bond prices are going up, right? They barely reacted to what the Federal Reserve said, right? What Kevin Warsh said, and the fact that the dot plot has completely skewed towards favoring more rate hikes, right? Instead of just pausing, instead of continuing to pause, they said, hey, rate hikes are basically going to be back on the table if economic conditions don't become better for their dual mandate. So again, the fact that the bond markets barely reacted to that is kind of confusing to me. But not just confusing, it's raising my eyebrows, right? I'm saying, what is going on here, right? So yeah, there's a lot of different factors as well. Like again, the private credit markets involving the AI infrastructure build out. But yeah, that's pretty much it, guys. I hopefully you guys are able to watch my other streams on this channel, take a look at it, and come back to this stream, and you guys will see how it ties in together, right? And also, if you guys really want to read what I've written for my members, even just last Friday, which was in the private CFO Discord chat room, and also read what I've written in February, right? On February, which is also in the private CFO Discord chat room. Make sure you guys become readers of the CFO Swing Watch report first, because if you do, you'll get access to the private CFO Discord. And you guys can see why I really believe is the reason why, right? Actually, let me say that again. I truly believe the actual reason why the bond prices currently have been moving up higher is due to the reasons I've outlined in the CFO Discord chat room last Friday and on February, right? So yeah, that's it for tonight, guys. Hopefully you guys are aware of what's going on with the bond markets. Again, it can be a very complicated topic to get into. I mean, I know a lot of people try to avoid the bond markets or anything revolving involving bonds at all. They just like to look at U.S. equity markets, and that's fine. But You guys have to understand that bond markets essentially tell you where the direction of equity markets could be going in the near term and long term future, and especially with the overall economy, right? And the markets will price in what the economy could be doing in the future. So yeah, bond markets are kind of the precedent, right? Of what precedent, not president, of what equity markets could be doing in the near term and long term future. Does that make sense? Oh, I see you guys' reactions there. Awesome, awesome, awesome. Thank you guys for the reactions there. Okay. So yeah, if you guys found this live stream very, very informational, but most importantly, potentially applicable in the long-term future as we head into the end of this year and into next year, make sure you guys smash the like button down below. And also, if you guys are new here, hit that subscribe button as well. Okay, have a great rest of your night, and I'll see you not tomorrow, on Wednesday at the same time at 8 p.m. Pacific Standard Time or 11 p.m. Eastern Standard Time. Have a great rest of your night, and good luck tomorrow.